Welcome to the latest edition of our CIO Insights. Since the start of the year, European equities have strongly outperformed US equities. This is rather surprising, as investor sentiment has been very negative on Europe and the belief in the continuation of US exceptionalism was strong with President Trump coming into office. Once again, most investors were caught on the wrong foot. Now the big question is, will Europe's outperformance continue? Let us first look at what has changed. Due to persistently weak growth last year and the moderation in inflation, the ECB started to cut interest rates last June. Rates have come down from 4% to 2.5% now. With the usual time lags, lower interest rates should have a positive impact on growth. Indeed, the economic data in Europe has started to surprise on the upside over the last couple of months. This is in stark contrast to the US, where economic surprises have turned sharply negative. Inflation remains a key concern for consumers, and confidence has fallen a lot. Also, the Fed is worried about inflation and has paused its rate cuts. While the Fed moved to the sidelines, President Trump is in the headlines. The start of the trade war and the end of support for Ukraine have raised geopolitical uncertainty to a new level. From a cyclical standpoint, it is quite likely that Europe will continue to recover while the US is entering a soft patch. However, the preference for Europe is also a result of rising structural headwinds for US equities. The launch of DeepSeek's latest AI model, developed in China at a fraction of the cost of rival US models, badly shook face in US technological dominance. The market's response to the latest earnings from the Magnificent Seven was rather negative, and the rotation towards other sectors that is underway is likely to continue. In our view, the current macro backdrop favors more defensive, high-quality business models, for example in the healthcare sector. Both China and Europe are likely to continue to outperform relative to the US market in the coming months. In the fixed income market, the recently lower US interest rates reflect the softer growth outlook and renewed hopes for rate cuts. We see limited further potential for bond prices to rise and remain slightly underweight in government bonds. On a relative basis, we prefer high yield and also subordinated financial bonds. While we started the year with a pro-risk positioning, we reduced equities to neutral in early February when Trump started his trade war. Given the high level of uncertainty, a broadly neutral allocation continues to make sense. We remain underweight in fixed income and are planning to build up some gold positions on weakness. While overbought in the short term, gold should continue to do well in the medium term thanks to additional demand from central banks and private investors. Thank you for your interest in our update. I wish you all good health and good luck with your investments in the coming quarter.